Hi, I'm Samir Jain at Active Allocator. I'm going to share with you a general approach to investing in hedge funds. So let me today draw your attention to our approach. At Active Allocator, we've created an allocation methodology that is complex, that is rigorous, that is thoughtful, that challenges traditional assumptions, and we address unique alternative investment issues such as survivorship bias, a serial correlation in returns, strategy drift, historical returns distribution issues. So what do I mean by this is a survivorship bias occurs when a data collector removes particular investments from the database and reports only the performance of the survivors. And the end result is usually an upward bias in indices. So we adjust the return series downwards for this. And serial correlation is the degree to which each period's returns mirrors the returns of the previous period. So the major reason for this bias is stale pricing, illiquidity, and smoothed returns. This artificially dampens volatility. So we statistically remove this bias to re-estimate the true return distribution. There's also this notion of strategy drift that involves a manager's discretionary change in investment strategy when opportunities disappear in their original trades. So we do a cluster analysis, which is a technique that seeks to group strategies that are highly correlated on a bunch of statistical parameters and distinguish them from groups that are less correlated. And this reduces the pernicious effect of style drift. Also, since volatility does not accurately reflect true risk in hedge funds, we optimize for higher moments of skewness and kurtosis too. So here let me introduce the notion of market directionality as a way to simplify and frame this discourse. Exposure to market risks drives hedge fund returns by arbitraging a combination of market risk, credit, liquidity risk. Hedge funds are able to implement a variety of directional and non-directional strategies. Our own directionality anchor is driven by market and credit risk, which in turn is driven by equity market prices, interest rate risks, prepayment and extension risks, concentration risk, and liquidity risks, amongst many other beta risk factors. For example, in equity investing directionality, the value of investments will fluctuate in response to general economic conditions and to changes in the prospects of particular companies or sectors in an economy. In fixed income investing, directionality drivers are interest rate risk and credit risk. In mortgage-backed securities, investing directionality drivers come from prepayment risk, interest rates. So in our framework, we are not prescriptive. You as an investor can arrive at your own view on markets, the degree of directional exposure you may want to take or not take. And what we offer is ways to allocate to take on that exposure. Our framework helps clients create low, medium, and high directionality exposures to the market depending on their preferences. Of course, low directional strategy buckets tend to underperform long bias strategies in rising markets. They, however, overperform in falling markets. Their results depend more on manager skills. They're also generally more complex to implement. And of course, medium directional baskets lie somewhere between low and high directional naturally. They focus on relative value arbitrage, fundamental investing, sometimes even distressed investing. High directional baskets have much higher exposure to markets. Their net long exposure to the broader market is much higher. So we, using this approach, are able to create tailored portfolios to meet investor needs, thereby delivering very specific risk-return trade-offs. So at Active Allocator, our general approach is to create directional exposure by bucketing different, for example, liquid alts in appropriate amounts to provide low, medium, and high directionality exposure. So for low directionality, we employ strategies such as equity market neutral, which by definition is something that is neutral to markets. M&A arbitrage that does not depend too much on the market, and statistical arbitrage, which is a relative value trade. For high directionality, we have strategies such as long short and global macro. The real devil is, of course, in the details in arriving at appropriate allocations, something that we do extremely well. Another concept behind creating such baskets is attenuating style and strategy drift. Managers can and they do change their strategy over time, which changes the statistical properties of their funds' returns. So how can investors then deal with this intriguing problem? Well, if the strategies drifted in an unsystematic pattern, finding a solution would be elusive. However, if managers moved systematically between subsets of strategies, then a more stable basis upon which to forecast and allocate might be possible. So at Active Allocator, we do a cluster analysis, which is a technique, as I've said previously, I guess, that seeks to group strategies that are highly correlated and to distinguish them from groups of strategies that are less correlated. This is one way to reduce the effect of strategy drift. We have a lot more that's up there on our website, and I encourage you to take a test drive on activeallocator.com or just get in touch with me. Thanks so much for listening in. Bye bye.